All right. Well, hello everyone. Thank you for joining us tonight for an overview of our Alternative Income Fund 3. I'm Mark Curry, co-founder of SMK Capital Management, joined by Dan Valenti, our portfolio manager. Before we begin, just a couple housekeeping items. We're going to cover a good amount of information, probably around 15 to 20 minutes of market data and another 15 minutes or so on our fund. Then we'll open it up to Q&A. But throughout our presentation, feel free to ask questions. You can use the Q&A chat box at the bottom of your screen. We'll run through all questions at the end. So let me go ahead and get let's see, here it is, the presentation. Okay. All right, so our fund is projected to provide investors with an 11 to 16% average annual ROI and an average cash on cash of 7 to 10% throughout the fund duration. So tonight's agenda, we're going to do a market update, discuss the trends in interest rates and inflation, and also different trends across the real estate sector, and discuss the question in a lot of our minds: is there a recession coming soon? From there, we'll dive into some of the details on our fund, including the diversification that we're looking to achieve and reducing risk, along with the recession-resistant asset classes that we've sourced for the fund, some of the unique characteristics of each, why they check all of our boxes, and then we'll run through the projected returns and open it up for questions. So Dan, maybe you could go ahead and start out with interest rates.
Thanks, Mark. Welcome, everyone. As I'm sure everyone here is aware, the Fed continues to battle inflation by raising interest rates. They've now raised rates 10 times in the past year, up 500 basis points or 5%. And there's potentially 2 more 25 basis point rate hikes on the horizon. This is the fastest rate hike cycle in recent U.S. history. However, in June, the Fed paused their rate hikes, which could be a sign that we are nearing the end of this rate hike cycle. Although the speed of this hiking cycle was much faster than predicted, and it caused some market turmoil, it is working to reduce inflation. So looking at this chart of the CPI, it shows that inflation has been dropping steadily since June 2022, when it peaked at over 9%. And in May 2023, inflation was at 4%, its lowest level in 2 years.
Thanks, Dan. Yeah, now looking forward, obviously there's been some progress made here. There's also a lot of data showing that the downward inflationary trend is going to continue. One point to note, oil price per barrel has been dropping. We're currently back down to December 2021 pricing. And then as you can see by this headline, why economists say it's a near certainty that housing inflation will soon fall. This is largely due to shelter being a lagging indicator. It's also arguably one of the most critical variables in CPI, Consumer Price Index. And it's lagging because CPI measures contract rent, that is the rents that are in place across the US, and not necessarily current market rents. And so the short takeaway here is that a lot of the data regarding rents and shelter is actually not up to date or current. And we are seeing that rents are still increasing in 2023. We will talk more about that in a moment. But the pace of the rent increases that we're seeing currently in 2023, which is a big component of inflation, is a lot lower than the pace in 2021 and 2022. And that's what's really keeping CPI down. When you can see this chart here, I think this helps kind of clarify what we're trying to mention. The green is the year-over-year change in CPI rent, and you can see it's just starting to plateau. In May-ish of 2023, we're starting to see it go down. And so this is where the headline comes from, where it's likely that inflation will continue to drop. Now let's talk about some of the real estate trends we're seeing. Before we get into data, just want to bring everyone up to speed. Generally speaking, we saw skyrocketing rents and pricing for most real estate sectors in late 2020 through the end of 2021. Rents were up over 15% annually. Some markets saw over 30% increases in rents. And then in early 2022, the Fed began raising interest rates. And the result was some weakening. We saw higher vacancy. You can see this chart here in orange. It's showing month over month change in US market rate apartment occupancy. So more vacancy and less occupancy through 22. And we also saw higher bad debt, which is a tenant's inability to pay rent, much slower rental rate growth. And then when we look at the end of this chart, the last several months through 2023, apartment leasing demand is actually back to very solid levels again. Vacancies remain steady at just over 5% since the beginning of the year. This is in line with long-term trends. And really what we're seeing is the vast majority of predominantly market rate apartment renters continue to pay rent on time. Rent collections in May came in at nearly 96% nationally. So just some positive trends to start the year. Definitely a bit of a change from an occupancy and a rent standpoint over 2022. Now, looking back at 2022, we also saw asking rents at apartments drop near the end of 2022. You can see that here. There's these 4 lines for the last 4 months of the year where the rents have actually gone down. This is the month over month change in the same unit, same apartments. But meanwhile, the rents have gone up for the last 4 months. And so we're just seeing a little bit more resilience here. It's also good to see that rents remain 25% higher today than they were pre-COVID in 2019. Just some points showing some of the resilience of the housing market, which is a big component of the economy and inflation. Dan, why don't we shift gears and have you talk about some more inflation numbers here?
Yeah, it's important to remember that inflation pushes rental rates higher. And as this chart shows us, May rent growth across the US was up 2.6% year over year. Now this growth, although it was positive, is the lowest since March 2021. However, on the bright side, it's now back down to more sustainable levels. And I think it's important to note that the average rent for single family homes rose to an all-time high in May at $2,100 a month.
Yeah, thanks, Dan. Really what we're seeing strong fundamentals of supply and demand weighing heavily on the real estate market. It's something we've been tracking for many years, and we continue to face a significant housing affordability crisis in the US. This has only gotten worse since interest rates began rising. Supply remains very low while demand remains strong. And these are fundamentals that are very important today. Really finding homeownership out of reach for many Americans. You've also got a lot of folks who have, low interest rates on their homes, 3%, hesitant to sell and jump into a higher rate, call it 6.5%, 7%. That's relative same trend for commercial real estate. Many owners sitting on the sidelines. So really supply constrained. A lot of people are waiting to see what's going to happen. There was a study done by Harvard. They looked at average monthly mortgage payment from March of 2022 to March of 2023. The cost has gone up by 30%. That's in 1 year. Really making this point known here that buying a house is the hardest it has been in nearly 30 years. Housing affordability is at its lowest levels since 1996. Another point kind of adding to this commentary, the salary needed to afford a typical US home is at an all-time high, where it's about $117,000 a year in order to afford the monthly payment. Okay, let's look at commercial real estate pricing. Now, we have seen pricing come down. This is evident in higher going-in cap rates when we're analyzing deals. And if we look at this chart from Green Street Advisors, it shows that commercial real estate prices are down about 15% from last year. Another data source, Real Capital Analytics, is showing the same time period a little over 11% down. Now, we also look at this chart a little closer, and what we're seeing here is the change in commercial property pricing for the past 7 years. And you'll see the leaders that have grown the most are industrial, manufactured homes, which are mobile homes, self-storage, and then in green down here, apartments. And then if you look more closely in just the last couple quarters, you see that industrial is actually starting to tick back up again, while manufactured homes are relatively flat, and the same with self-storage and apartments. Now, an important point, we're going to talk a little bit more about industrial as it's a selected asset class for our fund, but our operating partners on our triple net industrial portfolio that we've targeted for investment, they've been acquiring properties at about 200 basis points higher cap rate than what they were paying in 2021 and 2022. So that's a favorable trend. It really makes it an attractive time to invest in some of these assets. Dan, I'll shift over to you regarding recession.
Yeah, it's a question on all our minds. Will the U.S. enter a recession? And of course, nobody knows for sure, but a few recent headlines and indications of where we are. First, HSBC just predicted that a U.S. recession is coming this year. They do expect it to be more mild than past recessions, only decreasing GDP by 1 to 2%, versus over a 4% decline in 2008. Meanwhile, corporate bankruptcies have risen due to heavy debt loads and difficulty refinancing with higher interest rates. This could ultimately lead to an increase in unemployment. And on that note, recent data point, payrolls rose 339,000 in May, much better than expected, showing the resilience in the labor market, and unemployment rate at 3.7% in May, the lowest since 1969. Another indicator could be copper's recent surge up to over 12% in the past month, and it could signal some bright times ahead. It's a leading indicator just because it's input into so many things being produced.
Yeah, thanks, Dan. So, we have some more headlines. We'll run through them quick. Home price declines may be over from S&P Case-Shiller, and these are all within the last month. Very current information that we're sharing with you. This one, the housing market suggests that the U.S. economy dodged the recession bullet, is poised for more growth ahead. So this is based on strong data on housing starts that just got released. It's a key economic indicator, and May housing starts were up 21%. It's the highest in 30 years. There's a lot of signals all over the place of positive news, negative news, definitely a mixed bag. But this indicator is kind of a big deal because weakness, not strength, in housing starts is historically foreshadowing recessions. And so you kind of have the opposite going on here, where it's very positive information. Here you've got Mark Zandi, the Moody's Analytics chief economist, just recently mentioned that this time is different. He's betting against a U.S. recession. And he provided 5 reasons. And some of those reasons I'll review with you. The first one is excess savings. He's noting that there was $5 trillion injected into the economy during COVID, and that excess savings peaked in 2021 at a little over $2 trillion. But consumers are still holding about 500 billion of these funds as of May of 2023. Now, I'm a little skeptical on this excess savings. I think it's more of a fear that's in the market, that psychological fear, and that can spread, of course, to consumers, to business owners. A lot of people in general are just being a little bit more cautious with spending. So we'll see where this one goes. The second point he noted, labor hoarding, which is alluding to the fact that businesses are likely to avoid layoffs due to how difficult it's become in finding talent. So somewhat of the opposite of the point we just mentioned on the last slide, but that's the way things are going these days. A little bit of a tale of two stories. The third point I find quite interesting, the light debt loads. And what he's talking about here is, though, although household debt is near a record high, when you compare this with disposable income, consumers aren't typically overly burdened at the moment. He's pointing out that household debt service payments as a percent of disposable income were just 9.6% in the first quarter of 2023. When we compare that since 1980, the average has been 11%. So we're well below that. And then during 2008 crisis, it was around 13%. Now, when you shift gears and you look at businesses, he's also seeing a similar trend where businesses are, I'll just quote him here, devoting a near record low amount of their profits to debt payments, which frees up cash flow. He's mentioning that corporate interest payments as a percent of cash flow are now roughly 7.5%. And when you look at the 2008 financial crisis, it was around 20%. So some interesting points that have caused him to shift gears a bit and mention that he doesn't think there's going to be a recession. He also noted anchored inflation or inflation going down and low oil prices, which we just mentioned as well. Another headline here, this is Barry Sternlicht, the CEO of Starwood Capital Group. They're one of the largest apartment owners in the country with over 100,000 units. He just noted that he was a little early with his recession calls. I did not understand the strength of the consumer. Lastly, here we've got the New York Fed. Forecasting gets a lot brighter. What we're looking at here is they're looking at core inflation potentially going to 2.5% by the end of 2024. And down to 2.1%, excuse me, at the close of 2026. So it's a consensus here that inflation is going to continue to drop, but it's going to remain elevated for the near term. With that, Dan, I'll have you talk about the inverted yield curve.
Yeah, I mean, one of the indicators that we're looking at closely is the yield curve, and when it inverts, it has a very strong predictive value in if a recession is coming. So we currently have an inverted yield curve, which means the short-term rates are higher than the long-term rates. And so it's just, again, something that we're watching closely. It's something that has been really reliable. And so it is something to know.
Yeah, definitely something we're tracking. You can see that drop here in blue below the 0% line. Another important point, I think we'll start hearing a lot more about this in the next couple months or quarters, just the fact that 2024 is an election year. And historically, election years have proven to be strong economically. In fact, there's a recent study here, you can see the screen, but it was I'll just quote here, based on our analysis going back to 1960, we find that several measures of economic activity are actually stronger during presidential election years, including real GDP. So very interesting. We'll see what happens. Historically, election years have proven to be relatively strong from a economy standpoint. Okay, so in summary here, the question a lot of people are asking, is now a good time to invest? And if so, what's a sound strategy? And we do feel that now is a good time to invest because the market is providing us investment opportunities with very attractive risk-adjusted returns. We do think that it's a good time to be very cautious in what we're investing in and how we're investing, really focusing on reducing risk and being lowly correlated to the market. So some of the points that help us come to these conclusions that we've mentioned with you, we'll review a few of them today, but we've already seen discounted pricing versus peak pricing last year. Doesn't mean prices won't adjust further. They could, but we're already seeing a nice discount to that. And so we're not trying to time the market. We know that that is pretty much impossible. We're just making sure that we're making smart investments with very good going in costs and basis. We also have more clarity on interest rate trends now. We think, of course, that we're at or near a peak that will help bring buyers and sellers closer together in the next few quarters from a transactional standpoint. more deals are likely to get done. We are not anticipating that the Fed will reduce interest rates this year. We anticipate they're going to continue to raise them a little bit more, but all of that is uncertain. If and when they do lower rates, I think we'll also start to see a lot more consensus between buyers and sellers getting transactions done. Another positive, of course, unemployment remains very low, which is a very strong indicator of a healthy economy. And so, again, we're not seeing an imminent crash. We know, again, that it's impossible to time the market, but we think it's prudent to focus on investments that don't rely heavily on speculative growth, investments that can still produce attractive returns in excess of inflation and treasuries. We do think it's best to plan for a recession, although it's not a certainty. And we have always had that in mind since about 2018, when we've been focusing on some of these kind of lowly correlated or inversely correlated strategies. Do think inflation is likely to remain elevated for the near term. We are planning to invest with stagflation in mind, really meaning that if revenues are flat or going up just slightly, but expenses are going up, that's really a situation of stagflation. And we're seeing that across some sectors. Inflation, although it does help raise rents, it also increases expenses. That includes payroll, utilities, insurance, you name it, all of those have gone up. And so thinking about that with a sound strategy is definitely top of mind for us today. Okay, we're going to switch topics. We're going to talk about our fund, Alternative Income Fund 3. So before we dive in, I just want to mention, for over 13 years now, when we started our company, our focus has been on providing investors with diversified investment offerings. We like to diversify our capital across multiple asset classes, regions, and operating partners, really because it helps us reduce risk. And with all of the market volatility out there today, we named a few, of course, rising interest rates, inflation, recessionary fears. We find it prudent to be very cautious and careful with how we're investing today. Now, we're not trying to hit a home run here. The purpose of our fund is to reduce risk. It's to withstand market volatility and provide you with consistent income and growth. So let's review some of the details of our fund. Now, over the past 6 months, we've analyzed over 90 different investment opportunities. We selected a few today that we feel quite excited about, that check a lot of our boxes. So we're planning and have targeted to invest in self-storage, mobile home parks, triple net industrial, and a small portfolio allocation into some fixed income assets, including ATMs, and we have also targeted a private real estate debt fund. Again, the goal here, spread capital, reduce risk. Now, the objective of Fund 3 is to build a diversified portfolio with an attractive blended return of income and growth, again, with reducing risk. So our portfolio allocation, we are planning to invest about 20 to 30% of the capital in the fund into the fixed income assets, which could include ATMs or private real estate debt. The remaining 70 to 80% of the portfolio we're targeting to be allocated into the income and growth assets. That's the mobile home parks, self-storage, and triple net industrial. Now, this allocation is on purpose. It's allowing us to earn strong cash flow, beating inflation, while also leaving room for ample growth of invested capital. All right, so Dan, why don't we have you dive into some of the details on these fixed income investments we've targeted?
Absolutely. So let's first review the income generating investments, and we'll start with the private real estate debt fund that we've targeted. This is an established debt fund where our capital is being lent as a part of a large portfolio. Capital is lent predominantly to borrowers who are building large multifamily properties across the country with loan sizes in the range from 5 to 100 million. And the loans are short-term, usually less than 36 months. So once the property is built, the borrowers will refinance and or sell the property and then pay off the loan. The debt is a first position lien, which means we are the bank, and that means that we are taking a much lower level of risk than otherwise if we were equity investors in real estate. This fund currently has over 62 loans in the portfolio. It's highly diversified, and our operating partners have a stellar track record. They've paid off, they have 196 loans paid off, totaling $4 billion with 0 losses. The fund is providing investors with consistent quarterly returns with annualized yields over 10% since 2015, and it's fully audited, and the operating partners have a co-investment of $20 million with the CEO personally investing $10 million. So certainly aligned with his investment groups. Our second targeted income investment, which some of you may be familiar with, is into an ATM fund with an operating partner that we've had great success with over the last 4 years. ATMs provide us with consistent cash flow of 25% each year, but there's no growth since we are investing in equipment that depreciates. On the bright side, with this depreciation, we get large passive losses that we can write off from a tax perspective. So in summary, these income investments are projected to provide our fund with consistent annual income and limit variability of returns.
Okay, let's review the income and growth generating investments that we've targeted for our fund. Again, we're planning for these opportunities to make up about 70 to 80% of the portfolio. Now, the first is into a triple net industrial sale leaseback portfolio. And this portfolio targets private manufacturing businesses. For those of you not familiar with this asset type, the sale leaseback process involves a company that's selling the real estate that they occupy and then leasing the property back as the tenant from the purchaser. So it results in 100% occupancy at acquisition. They're already there utilizing the space. Instead of owning the real estate, they're leasing it. That helps reduce risk. We find this asset class and this sector and this strategy to be one of the best hedges against inflation and stagflation. The reasons are that the tenants are responsible for paying the property level expenses. That's the taxes, the insurance, utilities, building maintenance. Absolute triple net in the lease requires them to cover all those expenses. The leases are very attractive, 20-year leases with built-in rent escalations, which basically means the rent goes up every year at a predetermined rate, usually around 2 to 3%. And that is for the term of the lease. So you have higher rents each year, and your expenses are essentially zero. So a very applicable investment strategy with today's uncertainty. The properties are typically getting fixed rate debt at 70% loan to value, interest rates 5.75 to 6.5%, with a going in cap rate between 7.7 and 8.1%. So very healthy spread between the going in cap rate and the interest rate, something we're looking for. It's very hard to find these days, and that helps create positive cash flow day one. Now, the portfolio we've targeted already includes 6 properties in 4 states. You can see some of the pictures of the properties here. It's projected to grow to over 15 properties. And it's already producing positive cash flow. Investors have been getting 7% as of Q1 of 2023. The overall projected return is 15 to 17% IRR, 2x equity multiple, essentially looking to double investors' capital, with an average cash on cash of 8% plus. Our operating partners' track record includes 24 full cycle investments that have provided investors with an average annual return of a little over 20%. Lastly, it's a fully audited portfolio with our operating partner's co-investment of $3 million. And something rare that we also love to see here is the principals are signing personal recourse on the debts. So they are essentially signing on the line for the debt on the assets. That helps reduce everybody's risk, of course, because they are personally and financially in the deal. But it also allows, like, one of the reasons they're doing this is it allows them a lot more flexibility to exit the loans early if and when they want to sell or refinance. They don't have to pay large prepayment penalties or defeasance. So it really helps reduce cost. Okay, Dan, I'll leave this one for you.
Yeah, the next incoming growth investment is into a mobile home park and self-storage portfolio with a repeat operating partner that we continue to have great success with. Mobile home parks and self-storage are some of the most recession-resistant asset classes because they have a low correlation to the economy. In fact, you often see demand increasing during economic downturns. The portfolio we've targeted here is recently opened, and it has since acquired 5 self-storage properties in 5 states, totaling over 1,300 units. And our operating partners currently have several potential mobile home parks in due diligence as well. They focus on properties that have in-place income with upside potential through value-add measures, and the portfolio is expected to grow to over 12 properties. Project level projections for this portfolio thus far are 25% plus IRR and 2.6x equity multiple. Again, aligning with investor interests here, principals have co-invested $12 million across the portfolios with a commitment of $5 million for this portfolio. Finally, a highlight is the first self-storage property located in Henderson, Nevada, has 10 by 10 units currently renting for $50 to $60 a month, while market rents are near $200 a month. So there's plenty of upside potential on that one for sure.
Thanks, Dan. Yeah, they sourced that property in Henderson through a direct outreach to sellers. Apparently, the owner is an elderly female in her 80s, and her husband recently passed away, and she's not raising rent and also not collecting a lot of the rent. And so a good time to sell, and definitely a lot of meat on the bone on that first property in this portfolio. Okay, we're also in due diligence on a few additional investments. As mentioned here, if these opportunities do come to fruition and meet our investment criteria, we plan to add an allocation to our fund. The first is a mobile home park portfolio, 6 parks in the Midwest, over 400 lots. This is with a repeat operating partner that already owns additional parks in close proximity. Nice start here. Rents are approximately 20% below market with 87 vacant lots. So value add opportunity where you can raise rents over time and bring in new homes to the community and sell or rent them. Next, we have an additional mobile home park portfolio that we're in due diligence on. This is 10 parks in North and South Carolina. Conservative leverage, 65 to 70% 5-year fixed loans. They've already implemented 25% rent increases in Q1 2023. Lastly, we are looking at a tax-exempt apartment portfolio. This is 3 properties in Texas. We don't anticipate apartments to have much of a portfolio allocation in this fund, but if we do invest in apartments, it most likely would be a tax-exempt apartment offering. And if you're not familiar with this is a strategy in a sector that we've been investing in for a little over a year and a half, almost 2 years now, really where we have a unique niche where we're partnering with a local municipality, and in exchange for keeping 50% of the unit's income or rent restricted and the other 50% at market, you get a 99-year tax exemption. So you don't have to pay property taxes, which is a huge advantage and one of the reasons why we love these investments. So we'll see if this makes the cut or not, but wanted to share with you some additional investments that we're looking at the moment. Okay, let's quickly review the projected returns. We have 3 class shares for investors, Class C with a minimum of 50K, Class B 250K, and Class A 500K. You'll notice that we've simplified our cash flow and profit splits, really to reduce the administrative and accounting work behind the scenes. What we've done is we have a straight cash flow and profit split. There's no preferred return, there's no hurdles. So investors will earn between 80 to 90% of the net income that comes into our fund from operations and property sales with no limit on the upside. And SMK would earn the difference of 10 to 20%, depending on the class share, of course. Now, this is a higher split to investors than our typical preferred return structure. Those investments usually have 70 to 80% split to investors. And what we're doing here is we're creating a bit of an incentive to ensure that we select high cash flowing and highly profitable investments. And again, it helps keep the fund accounting much more straightforward. Now, the result, if you look at the projected returns, we have an average cash on cash to investors of 7 to 10%. That's distributions while we hold. And then a 1.55 to a 1.7 equity multiple. And an average annual ROI of 11 to 16%. Now, on the right, you'll see that we have also lowered our asset management fee from 1.25% to 1%. And this is on capital invested. We have a one-time acquisition disposition fee of 1%. And we're projecting an investment term of 5 years. We do anticipate the return of capital to begin in earlier years, 2 to 4, from property sales, refinances, potentially redemption through the private real estate debt fund as well. We're planning to do investor distributions quarterly. And you can see the projected annual cash flows. This is net to investors beginning in year 1, 4 to 7%. That's giving us enough time to raise capital, invest in these deals, and have our operating partners start providing us distributions. And then in year 2, up to 7 to 9% for year 2 and year 3. And then year 4 and year 5, 8 to 10% from there. Now, we've already begun receiving capital from investors. And what we wanted to do for anybody on this call tonight is extend our Founders Shares management fee promotion to you. If you're ready to make an investment, we'll waive our management fee for the first year and a half. And this allows folks to earn higher returns, really reaching the upper end of the ranges noted in each of these class shares. So for next steps, feel free to log into our portal on our website. We have a lot more detail on the investments that we've selected for the fund, along with interviews with each of our operating partners. You can sign offering docs electronically and access wiring instructions there as well. My contact info is on the screen. If you have questions, let me know. After our Q&A session, we're happy to continue to communicate one-on-one. Okay, let's shift gears. We'll move over to Q&A. Maybe what I'll do, Dan, is I'll stop sharing and we can dive into the questions that we've gotten so far.
Sounds good. First question. Seen some recent data from TREP, and it suggested that if mortgage rates stay at 6% or higher, more than 1/3 of CMBS loans, commercial mortgage-backed loans, maturing by year-end 2024 could not be fully refinanced without debt service falling to dangerously low levels. What are your thoughts on how that will impact the real estate market and specifically Alt Fund 3?
Sure. Yeah. So, there's definitely some distress in the marketplace. We're seeing that predominantly in the office sector and some retail as well, where the fundamentals of those two asset classes have, of course, greatly changed in the last couple of years. So we don't anticipate, if that's the figures that they're noting, Dan, those to really affect our fund because we don't invest in those asset classes. Apartments is another one that's top of mind for folks, where we're starting to see a little bit of distress from predominantly from properties that were acquired at the peak in the last few years, usually with floating rate debt, some of them without interest rate caps, with operating partners that maybe aren't able to operate the assets. There was a portfolio of a little over 3,000 units in Houston, for example, that just recently got foreclosed on. Those are apartments. And it's interesting what happened there, but essentially, I guess I'm hesitating a little bit because this operating partner was actually referred to us by an investor. So I talked to them, and we didn't make an investment with them, and actually didn't really get very far in our talks with them. Essentially, the operating partner, where they saw these foreclosures, ex-IT professional, and just didn't have much real estate experience. Seemed to be good at raising capital, but he also didn't really have a team behind him. So how he acquired and owned, I think it was over 7,000 units, without a track record, without a team, that was just a big red flag for us. So we actually spoke to them, but didn't get very far. Obviously, our diligence proved us pretty well in that situation. But those properties have since gone back to the bank due to very aggressive underwriting. I think we saw the interest rates maybe were in the mid 3% when they bought these properties, and they went up to 8%. So probably didn't even have an interest rate cap on them. And we heard that there was a lot of deferred maintenance, and there wasn't any work getting done, and just a lot of neglect. So I think if you have that kind of situation, yeah, you're going to see some distress. I think if there's other assets where you have floating rate debt, but a strong operating partner, the real name of the game is, I think, for some of these assets is survive till 25, right? That's what we keep hearing. And what that's essentially meaning is ensure you have enough liquidity and capital to continue to operate, because a lot of these deals that did have floating rate debt on them were in more heavier value add deals. Dan, you know this, of course, where you're renovating units and you're bringing up rents, and we continue to see a big gap between unrenovated and renovated units. So as long as you can continue to execute on the business plan, you probably won't see a ton of distress there. There's also a lot of capital waiting on the sidelines to potentially help. Rescue capital, vulture capital, call it what you will. I think that that is something that we probably didn't see much of in 2008. So there's articles about this, but a potential where if there is some distress that hits the market, it's probably going to get bid up a little bit as well. And so there's going to be a lot of competition for those assets, should a lot of them come to market. So I hope that helps answer the question, but why don't we keep going?
Yeah, as this is Alt Income Fund 3, can you just talk a little bit about the performance of Fund 1 and Fund 2 and differences to this fund?
Yeah, absolutely. So Alternative Income Fund 1 and 2 were focused specifically on mobile homes and self-storage. They remain some of our favorite asset classes today. It has become much harder to find great mobile home park and self-storage deals. It's harder to find a lot of great deals today. So with that, we look at the three funds, and I think it's important to note that Alt Fund 3 that we're talking about today is targeted to have more diversification through asset classes, through operating partners, through some fixed income and growth, and that should help lower risk. But also regarding performance of Fund 1, we've provided our investors with 7 consistent quarterly distributions, right in line with projections. Fund 2 as well, we've got 3 quarterly distributions. We're entering year 2 on Fund 2, or entering year 3 on Fund 1, and they're performing in line with projections. So we're quite pleased with them. I think, again, the takeaway here is Fund 3 has more diversification, spreading capital across different deals.
Okay, can you talk about maybe when you expect distributions to begin?
Distributions begin, yeah. So we're expecting initial distribution to occur within 2 quarters of when investors fund their initial investment, if not sooner. And then our goal is always to provide investors with quarterly distributions and reports within 60 days of the close of each quarter.
Have you done background checks and verified references for all operating partners?
Yeah, yep. We conduct background checks on the principals of each of our operating partners. We also a lot of our operating partners come to us from investors that refer them to us, and so you have more of an organic, I would say, source. And so you have folks that have oftentimes have active capital with them. Hey, these guys are doing well. We're getting great returns. You should go talk to them. And so we do references organically, we do referrals, and we do background checks. We're always really focused on the who we're partnering with first before we look at any deals.
When do I get my capital back?
Sure. As we mentioned, we're projecting a 5-year investment timeframe. There may be a few investments that go a little bit longer, like ATMs or 7 years, but based on the cash flow projections in our history investing in ATMs, you actually get all your money back in about 4.5 years. And so return of principal comes before 5 years, but the majority is projected to be returned to investors within 5 years through property sales and refinances. So we anticipate years 2, 3, 4 start returning principal.
Are your return rates you showed net after all of your management fees are subtracted out?
Yes, that's all net. Net to investors, correct.
What do you see as the biggest risk to not hitting pro formas or losing money in this fund?
Sure. We actually have answered that recently, but essentially, what we're trying to do is diversify and reduce risk, right? This is something that we focus on. It takes a lot of time and effort versus investing in just one investment. So we reduce risk by diversification. We're spreading capital across lots of properties. As you can see, we've actually targeted portfolios. So even in industrial, we're spreading capital across multiple states and properties. And then in self-storage, we're spreading capital across multiple states and properties. And so we find that very helpful, where if there is an unexpected event, 1 or 2 or 3 of the properties maybe aren't performing up to pro forma, it really won't have as large of an impact on overall returns for the fund. That's a big part of downside protection, capital preservation, reducing risk. Now, of course, there's always risk with every investment. We have a ton of those risks summarized, of course, in our PPM offering docs. I think another risk that we mentioned to folks when they ask, of course, is if we're not able to raise sufficient capital, our ability to invest in each of the target investments or the allocation that we're targeting could be impaired. Maybe if it takes too long, some of the investments may no longer be available. We might not be able to meet their minimums. I mean, these are all risks, of course. I think, one of the things we do, and one of the reasons we offer founders shares, is to raise capital sooner so we can go out and make these investments while they're still available. So that incentive helps reduce that risk, I think, as well. One thing, Dan, I think I'll answer that a lot of people ask, we forgot to mention it today, is just regarding tax advantages, depreciation. I know you mentioned it on ATMs, but our triple net industrial properties are doing cost segregation studies at each property, and we anticipate our self-storage and mobile homes to have the same. And so they're going to get additional passive losses through those in year 1 and most likely into year 2 as well. And so we're anticipating and projecting between 40 to 80% passive losses in year 1 and potentially further losses in future years. I know that's something a lot of people are always looking for, and good to mention that as well.
When do I begin accruing a return?
Yeah, so we basically have a fixed income waterfall structure. we have a profit split waterfall structure, and some of the investments have fixed income. And so there isn't an upside to them, which is also part of the reason that we decided to create that waterfall structure. For example, the private real estate debt fund, there's no profits at the back end, right? You get a nice cash flow while you hold, and you can redeem your interests after at least a 1-year lockup. You get your principal back, which we would then return to investors. But there's no upside. And so with that, really have different varying cash flows coming into the fund. They'll be split between investors and management, as we noted, based on each investor's class share. And we plan to have several closings. Our first closing is the end of June. We'll notify investors of that closing, of course, and returns will be calculated based on which closing tranche investors fund their investment in. And so it's kind of a long-winded answer, but it's not necessarily accruing a return, but it's based more on the closing time frame of when folks invest.
Right. It's different from previous offerings where there's been a pref where if it's not hit, then it kind of rolls over and it accumulates, and then you get paid off as operations kind of catch up to that, right? Everything that comes in goes out.
That's how we're doing it. It's much simpler. Also, it's the same way we do our ATM investment. Dan, you're familiar with that. I know a lot of our folks are in that. It's just a straight cash flow split. Because there's no upside, right? ATMs depreciate. There isn't a lump sum return of principal at the back end. There's no profits at the back end. We're doing it for the cash flow and the income. So very similar strategy as we have there.
All right. I think one more. How long are founder shares available?
Yeah, good question. So in our offering docs, we mentioned it's for the first $1 million invested. We have already begun receiving capital. At this time, we have our first closing at the end of this month. We don't know yet if we'll be at the $1 million mark. We are getting closer, and so I think the clock's ticking. If you're curious about timing of investment, just talk to us. We can see if there's flexibility and stay in contact there for founder shares. But again, we're extending that to everybody on this call.
I think we've cleared all the questions.
Okay. Anyone else have any more questions tonight? That might be it. All right. Appreciate your time, everybody. Thank you for joining us. Take care. Thanks.